So for the end of the day, a little bit of food for thought. It's not so much about BitMEX. We want to show or share our view on the markets. So just one sentence, BitMEX is one of the leading and oldest crypto derivatives exchanges in the world. We're welcoming any professional traders. We are basically a good mixture between a centralized and a decentralized exchange. We have proof of reserves, proof of liabilities, covering more than 90% of all of our assets, and we do it twice a week. So stay tuned. But what it is about is, where are we in the market? We're meeting here at TOKEN2049. People are excited. Finally, the bull market has started. For us as traders, we are traders, not so much investors and builders. We look at timing. Timing really is of essence if you trade and when you want to make a living out of trading. So, what is it to look for? For me, it's always two things as a trader. What actually pushes money and funds into the crypto ecosystem, which is a macro environment. And the second one is, how attractive is that crypto ecosystem and how much is it adopted? So it's a self-fulfilling prophecy and a self-re-establishing feedback loop. So let's go for global macroeconomics first. The thing that drives crypto adoption, especially for main coins, is global debt levels, inflation and monetary policy. And while people think right now, and this is the positive side of things, that this is over, it's not. This shows you the growth rate of debt, of public debt in global economies, like the United States, the Eurozone, Japan, and China. And what you see is not only that it grows percentage-wise, but even the percentage rate is growing. So you have what many people don't see or don't see really, a exponential growth in public debt. Usually exponential growth in public debt goes to interest rates and inflation rates. We have seen high inflation in the last 2 years, and we have seen the reaction of major economies for growing interest rates. Growing interest rates, so the risk-free rates, is actually bad for anything that happens in crypto, because crypto is a risk-bearing asset, and at the same time, you have now higher interest rates, higher returns on risk-free assets, or so-called risk-free assets. So you see the debt cycle actually is good. The interest rates do not call for any major action yet. But then the question is, how did that work with the rising prices we had? Interesting thing here is, if you look at the up here, last cycle, first interest rates fell, with that the debt levels and the liquidity supply rose, and then you had the Bitcoin price action. This time actually the Bitcoin price already leapfrogged the actual interest rate environment. So you see that on that end, Bitcoin went up, and with it the whole crypto market cap, but interest rates haven't come down. So you see that's maturity, meaning you trade expectations, but expectations actually can be, you can disappoint your expectations, and then you have a correction. So here it's a little bit of risk as well, because depending on how long the interest rates will stay higher, there is the opportunity for a correction. So this is what drives money and funding into the crypto ecosystem, and it starts with Bitcoin, it starts with the main coins, and then it trickles down into everything else, like the meme coins, the level 2s, etc. So, but what is the attractiveness of the crypto market? So we see this event, it's great. And you see that total market cap is close to an all-time high, which is the first step to new all-time highs. This is good again, so that's a self-enforcing or reinforcing feedback loop. What is good too, and what I usually show to my friends, is this chart. It's the crypto adoption that is untouched. You see the total addresses of Bitcoin and total addresses of ETH, as well as the USDT addresses. It's constantly growing since 2018 and even before that, but it's growing heavily, right? So this gives you, hey, crypto adoption is on the rise. A little bit of caution. If you compare the active addresses, which actually gives you how many people or how much transactions there are, it's a pretty stable one, which is interesting. So it's not stable, it went up. So if you go for the Bitcoin addresses here from 3 million to now more 5 million-ish, it is growth, but it's much lower than you would expect on an intuitive level if you see the total addresses. So on ETH, it's even more so. And that means the really active people in the crypto space are more or less the same all the time, which is good and bad at the same time. It is good because there's a lot of opportunity. It's not so good because it means this bull run that takes us to the really next level isn't there yet. So what is different to the years before or to the last cycle as well is that institutional money comes to the crypto space. Not so much to meme coins, not so much to NFTs, but to anything else. We had the ETFs, we will have more ETFs to come. So, and why is that the case? Because of regulatory process. All of us might not like regulation, probably, maybe, I don't know. But at the same time, it ensures that people come to the space and can come to the space that wouldn't touch it elsewise. So this is a positive sign again. So my take is, yes, we are in a bull run, but we are halfway through. We basically have seen the first price action that started already last year, so like March, April 2023, which means taking into account the usual crypto cycles, which are around 2 years, we're halfway through. So the question is, what is to be expected as a trader, right? I mean, I'm not talking for builders. It's much more long-term, but as a trader in crypto, you're looking at something like 3 to 6 months. ETF, big thing. Everyone says that was a game changer. It was, and then it wasn't. Why? Actually, you see the ETF rise, but it plateaus. Over the last couple of days, we even had net outflows. We will have new ETFs coming, especially for Ethereum, as well as in Hong Kong. So there will be more inflows, but not on a very big scale from my point of view. It's kind of a saturated market. And the thing is, it happened before the halving. Usually during halving, let's say before and after, you have quite a lot of volatility because no one knows, especially for Bitcoin, or for Bitcoin, what miners will do. Will they sell off because they expect to go out of business? Will they hodl? Will they just cover their operating expenditures? And no one actually knows. You try to predict, people try to predict that. I think it's unpredictable. But what you know is, around halving, a lot of volatility and even opportunity or risks of corrections. What I wanted to show here is that the ETFs won't actually smoothen that out because there won't be an inflow in the next couple of weeks or months to come that is so huge that it will eat up the volatility. So be cautious as a trader. Interestingly, we see a rising open interest, especially on Bitcoin futures, which has probably to do with the ETFs. Because now TradFi guys can do a basis trade. A basis trade is the most simple trade for arbitrage in the crypto world. It has driven the whole trading in crypto like for the past years. And now actually people don't need to touch a Satoshi to do that. They buy Bitcoin ETFs and they sell Bitcoin on the CME. Fully US dollar, just in the prime brokerage market, no touch of fiat, no touch of crypto at all. Question is, what happens with those positions when they are unwound? So what happens? Will they roll, or will people, because the prices go down of Bitcoin, just go out of their positions, which would create a sell pressure, because they will sell the ETFs. The ETFs in turn need to sell Bitcoin, and so you actually accelerate. For me, the ETFs can accelerate whatever we see in the market. They don't drive it. And meanwhile, interesting again, Bitcoin and Ethereum exchange balances have reduced significantly in the last 4 years. Part of it due to decentralized finance, good for the crypto ecosystem, partly because those funds have flown into more TradFi geared and more traditional institutional investors' crypto wallets, which are non-off exchange and basically self-custodial. So which is good, again, and bad at the same time. good for the DeFi space, not so good from my point of view. And I'm not bashing institutionals, but we lose the transparency in the market. We can't follow what's going on anymore, which was a big thing in crypto for a long time. So what fueled the last crypto price and price appreciation and the adoption? It was the previous Bitcoin halving events, media attention, especially on Bitcoin. We had a lot of ICOs and stablecoin issuance and the stablecoin pickup. We thought, and everyone told you in the last bull run, institutional investment will come, but it never did. The idea of distributed computing power, especially in DeFi, spurred the last run. And we had micro frenzies like NFTs, ordinals, and fan tokens. That was it. So what is it today? We have again Bitcoin halving, so tick the box, we know how to deal with it. The institutions are already here now, which is they use the bear market. We have elections in the larger regions of the world, which might cause some volatility. We actually have a complete technological maturation of layer 1 networks from my point of view, so I don't expect anything major to happen in level 1 networks. We still have new chains coming, but it's just a me too. Bitcoin actually now is the gold standard of the crypto ecosystem. It is the reserve currency, so I expect the other coins to grow much faster, but Bitcoin still to grow too. It's a little bit like, not coming to the narrative of the gold, but like gold. You hold gold, and the more money you have, you more absolutely hold in gold, but the other stuff is growing faster. However, the risk is bursting bubbles in heated markets. I mean, here it says like real estate and stock markets. Yes, of course, but even in the crypto ecosystem as well. We had the meme coin, or we have the meme coins right now, which is more a consumer product. And it's very interesting, it's very exciting, but it can end any time, as the NFT frenzy did last time. So, thank you. And what I wanted to say with that is, there is a lot of opportunity for traders. If you're willing to trade, if you go in front of your screen, if you analyze the market, if you look at the data, just ride the volatility wave up and down, because I expect it to be in a range, a little bit of a risk of a correction in the next month, but overall until the end of the year, like Q3, in the middle of Q3, end of Q3, maybe new all-time highs. But it's not a given thing like what we see here. Tomorrow we will be at 100,000. So position yourself wisely and be prepared for what's out there. We are trading like this. We're happy and we love trading. I hope some of you like trading as well, and we welcome you on BitMEX. Thanks for that, guys.